The following program paid for by Lifespan Wealth Management. Providing financial advice since 1993. It's time for Your Money with Sherry Goss, Randy Goss, and Jonathan Eisner. And now from the Macon studios of News Talk 940 WMAC, it's Your Money.
Good morning, Middle Georgia, and thanks for tuning in to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning advice and manage our clients' investment accounts. So if you're looking for an investment advisor, call our office at 478-922-8100 to set up your complimentary consultation.
Lifespan Wealth Management has offices in Macon and Warner Robins for your convenience and has been serving Middle Georgia for over 30 years. You can learn more about our services by visiting our website at retirerelax.com. And while you're on our site, go to the special reports section where you'll find several reports that are available to you for free. You can also sign up to receive our digital feeds, which are short videos providing great information relevant to retirement, investing, and matters that affect your money.
We also offer seminars to the community at no cost. So if you're in need of a guest speaker for your church or civic organization, give us a call, and together we can decide what topics you would like us to present to your group. Again, our contact number is 478-922-8100.
Good morning, everybody.
Good morning.
Good morning.
So, you may not think that this has anything to do with your money, but I would disagree. So, here's the topic that I picked to kick off the show. The subject is why regulating ultra-processed foods, or UPFs, is a public health priority. I've been very concerned about this for years. Ultra-processed foods have become a dominant force in modern diets. Unlike natural or minimally processed foods, UPFs are industrial formulations designed to maximize profit and encourage overconsumption, exploiting the brain's reward and appetite mechanisms. Addressing this impact is no longer a matter of personal choice, but a public health necessity.
I agree. The marketing is so misleading, and in many cases, producers want you to remember mom's home cooking from your childhood, but the ingredients in these packages are far from that. But they taste good, and you're right. It exploits our brain, and you crave more of these bad things. Food companies are using decades of neurobiological research to engineer products that maximize profits by exploiting our brain's reward and appetite systems at the expense of our health. And according to an article, one person dies every 4 minutes from diet-related causes linked to UPF consumption, which strongly linked to obesity, type 2 diabetes, hypertension, cancer, cardiovascular disease, depression, dementia, cognitive decline, liver fat accumulation, and so on. The scale of harm makes UPF a public health emergency. UPFs now provide more than half of the calories in U.S. diet and account for around 70% of the national food supply. It's terrible.
It is so, and I get why people want to eat this stuff. So I cannot buy Doritos or spicy Cheez-Its because if I open the package, I can hardly control myself. So I get it. So you have to stop buying it.
You do.
You have to just keep it out of your house.
You got to have it out of your cupboard or you'll be in it.
Yep.
So,
Any comments, guys? Nope.
No, I mean, that's the reason we got it out of our house a long time ago. And when we do occasionally bring something in, just because it tastes good, it doesn't stay around long. I mean, we just kind of go through it too quick.
Yep.
So we cave to it as well. All right, let's talk. Yeah, it is a challenge. Let's talk about why Donald Trump's tariffs are failing to break global trade. And this is from The Economist. On April 2nd, President Donald Trump unveiled the Liberation Day tariffs, holding up a board covered in figures showing just how unfairly the world treated America. The message was clear. The age of free trade was over. Markets shuddered, America's allies fumed, and the economists predicted catastrophe. Torsten Slok of Apollo, a private markets giant, put the odds at a tariff-driven recession in America at 90%. In parts of America's economy, the pain is real. Prices of durable goods, a category that includes appliances and cars, rose by over 3% at an annual rate in the second quarter of 2025, the fastest rate since the early 1990s. Of course, that excludes the COVID-19 pandemic timeframe. The price of toys, mostly from China, is growing at nearly 5%. A similar unusual pace. All told, tariffs are adding about 0.3% percentage points to inflation. Employment has weakened too. In tariff-exposed sectors such as manufacturing and retail, bosses blame higher cost and uncertainty. Consumer sentiment in September was the fifth below its level a year ago. Relative to a world without tariffs, America is worse off. Yet, there is no runaway inflation. Consumers are spending, firms are investing, and the stock market is booming. The outlook has also improved elsewhere. In September, the OECD, or the Organization of Economic Cooperation and Development Organization, lifted its forecast for global growth to 3.2, up from 2.9 just 3 months earlier.
So why the good news? One reason is that tariffs have been gentler than advertised. In April, America's average rate was estimated to be near 30%. Today, the same models put it closer to 18%. Trump threatened China with tariffs of 145%, but by September, he was imposing levies at barely a third of that. South Korea's fell from a promised 25% to 15%, and even Lesotho, I had to look that one up, it's a poor landlocked country in South Africa that sells mostly clothes to America. It was somehow assigned a tariff of 50%, but that was never actually applied.
So I wonder if this is in the news, if anybody actually hears this. I mean,
it's a great point.
I haven't heard it anywhere other than in this article from The Economist, which is a left-leaning publication.
Not totally.
Not totally, but it is more left-leaning.
Okay.
Yeah.
Anyways.
Well, another thing that has helped is there have been lags in implementation, which has softened the blow. And the Supreme Court ruling may block a lot of tariffs. Companies are waiting for more certainty before passing on higher costs to consumers.
Yep, you're right. And carve-outs have blunted the impact even more still. Nearly half of America's imports have been exempted from the tariffs. Electronics, such as smartphones and computers, were spared entirely. Brazil's rate of 50% includes nearly 700 exemptions, trimming it to 30% or so. Canada's headline tariff of 35% is closer to 6% in reality. This is largely because goods qualifying under the United States-Mexico-Canada agreement are exempt. Even sectoral levies are riddled with loopholes. Trump's new pharmaceutical tariffs, announced at 100% and due to take effect on October 1st, excluded generics and branded firms with investment plans in the country. That day, he paused the measures altogether as talks began.
Don't generics make up about 90% of the drugs sold in America?
Yes, they do. But even after all the things we just mentioned, the carve-outs, the gap between tariffs on paper and tariffs in practice is very striking. The Budget Lab at Yale estimates that America's implied tariff rate, derived from customs data, is roughly half what it should be given current policy.
Yeah, but the unaddressed question is, what did the Trump team negotiate with these nations outside the tariffs that matter to our nation? If nothing else, it seems that he got people's attention and he was able to make some deals for bringing manufacturing back to the United States.
Another part comes from rule dodging. Economists assume non-compliance of about 10 to 15%. Trump's complex rules seem to have even increased this. The gap between what China reports exporting to America and what America reports importing from China has risen, despite the end of the de minimis exemption for small parcels.
Yep, that's a good point, Corey. But it's an old Chinese sleight of hand, and of course, it is to evade tariffs. Since 2018, there have been significant and growing discrepancies between the U.S. import figures and China's export figures.
Some firms may be under-invoicing. Whirlpool, an American appliance maker, has alleged to regulators that its rival cut declared customs values after the new duties took effect. Reclassification may also play a role. The share of Canadian exports deemed compliant under the USMCA has jumped, suggesting a lot of relabeling.
Most consequential has been what has not happened: retaliation. Economic models assume tit-for-tat tariffs. Instead, America's trade partners have largely held fire. Few are big enough to inflict real pain on America by themselves, and there has been little coordination. That may be because America matters less than it once did. At the turn of the century, it accounted for a fifth of global imports. Today, closer to an eighth. Brazil sends only 13% of its exports to America, down from 26% in the early 2000s. Even where dependence remains significant, as in Southeast Asia, countries have little incentive to retaliate. Rather than retaliate, many countries are diversifying their trade. China, the main target of Trump's tariff, has seen exports to America plunge, but overall trade has held up. From June to August, the value of its shipments grew by 6% year over year, with sales to Southeast Asia up by a fifth and to Europe by nearly a tenth. Textiles have flooded European markets, where imports of Chinese clothing and fabrics rose about 20% in the first half of 2025, again against a year earlier. Electronics are pouring into Southeast Asia.
Yep. And Trump's tariffs are also pushing others together. Canada has deepened ties with Mexico as the two prepare to renegotiate the USMCA with America next year. On September 23rd, the EU signed a long-delayed deal with Indonesia, scrapping high duties and industrial goods. It is also nearing a pact with India. Many countries are edging closer to China, unfortunately. The Association of the Southeast Asia Nations has upgraded an agreement with the superpower. Chinese investments in Brazil surged by over 60% in the first half of the year compared with the same period last year, all of which raises the question, what have we gained? Tariff revenues have risen by $19 billion a month from last year, although that offsets the cost of Trump's recent tax cuts. But we still have a very large budget deficit, and we need to address, and very soon. And Trump plans to use much of the extra revenue to compensate losers that have been hard hit by the tariffs, such as farmers turning tariffs into a regressive tax.
So far, American firms have absorbed most of the tariff cost. Fat profit margin and inventories imported before the levies took effect have made a difference. But as these buffers diminish, prices will rise. The Budget Lab at Yale estimates that tariffs will reduce household incomes by about $2,400 a year. Since Trump's staggered rollout spreads the increases over several quarters, what might have been a one-off shock risks becoming persistently higher inflation. With short-term inflation expectations already edging up, that could lead the Fed to keep interest rates higher than they would otherwise, and in time hurt demand. How other countries navigate America's tariffs and China's industrial glut will shape the next phase of global trade. Some are starting to put up barriers of their own. Mexico plans a duty of 50% on Chinese cars. The EU is preparing to join America and Canada in curbing cheap Chinese steel by cutting import quotas and raising tariffs. In Southeast Asia, a flood of Chinese goods is prompting governments to weigh new safeguards.
On another note, JP Morgan Chase launches a $1.5 trillion plan to bolster U.S. economic and national security. The effort, dubbed the Security and Resilience Initiative, will direct $1.5 trillion towards projects spanning energy, manufacturing, and defense. As part of the plan, JP Morgan Chase will invest up to $10 billion in direct equity and venture capital funding to help select U.S.-based companies to enhance their growth, spur innovation, and accelerate strategic manufacturing.
Yeah, I imagine they're going to have a checking and savings account with them to get these funds, though.
And Jamie Dimon, the CEO of JP Morgan Chase, said that it has become painfully clear that the United States has allowed itself to become too reliant on unreliable sources of critical minerals, products, and manufacturing, all of which are essential to our nation's security. So they are taking the action.
Dimon added that our nation's security is predicated on the strength and resiliency of America's economy. America needs more speed and investment. It also needs to remove obstacles that stand in the way. The obstacles he referred to are excessive regulations, bureaucratic delay, partisan gridlock, and an education system not aligned to the skills we need. And I agree with all of that.
Yeah, and this is huge. I can imagine Dimon putting pressure on other industry leaders and bankers to do the same thing that he's doing.
The company said it will focus on 4 key areas, including supply chain and advanced manufacturing, defense and aerospace, energy independence, and resilience and frontier and strategic technologies. These 4 areas are further broken down into 27 sub-areas, which range from cybersecurity to nuclear energy to critical defense components, as noted in the announcement. This new initiative includes efforts like ensuring reliable access to life-saving medicines and critical minerals, defending our nation, building energy systems to meet AI-driven demand, and advanced technologies like semiconductors and data centers. Our support of clients in these industries remains unwavering, Dimon said. And this reminds me almost of when he said he was going to run for president.
It kind of
Years
sounds like a
ago.
campaign stunt, doesn't
Yes,
it? Yeah.
it reminds me of that.
Well, J.P. Morgan, they also said that they will advocate for policies aimed at accelerating these efforts and conduct targeted research on private companies and supply chain issues related to rare earth, AI advanced technology, and AI advanced technology. They have already planned about $1 trillion over the next decade to support these sectors. With this initiative, the firm is increasing that total by another $500 billion. And to close out this topic, Jamie Dimon said it best. He is hopeful, as America has in the past, will all come together to address these immense challenges. Dimon said, "We need to act now." And
I agree.
And he keeps saying things like this. So I agree with you, Sherry. And I don't know how people feel about Jamie Dimon as a presidential candidate, but he always seems to have America
First.
On his best,
first,
yes,
best interest.
absolutely.
Yep.
Yeah.
And he talked about running years ago, and then he backed out because he was just too overwhelmed. But I feel like this, it just feels to me like that's where he's headed.
Exactly.
Planting the seed.
Plant the seeds.
Then, on the flip side, Jamie Dimon says the market looks unstoppable, but at the same time, he sees a 30% chance of a major pullback or correction.
That's a chance.
Right. Admittedly, he says he's far more worried than most others. In case you didn't know, Jamie Dimon created the Fortress balance sheet for his company, and that helped J.P. Morgan emerge unscathed from the 2008 financial crisis. And he believes investors are downplaying the risk of a major market correction, one that could slash stocks by about a third.
Yep. Let me jump in here, Jonathan. Sherry and I went to speak to a speaking engagement this past week, and one of the topics was about the possibility of a market correction. And with valuations the way they are now being elevated, it is a real possibility. The question that no one can answer is when that correction will materialize or the magnitude. Right now, you hear comments using the words to describe the market like overvalued, inflated, or frothy, and there's others. And they're correct. The Buffett indicator, and that was created by Warren Buffett, is very straightforward indicator which simply divides the value of the stock market by the annualized gross domestic product. Currently, the results of that formula show 200% indicating that the U.S. stock market is overvalued compared to our GDP. This level is about 2.2% standard deviation above the historical average, suggesting caution for the long-term investors. And this is about 68% higher than the historical average. Now, to give you some context or an example as a reference, the internet bubble, the .com bubble, is being used as an example in discussions. Back then, the Buffett indicator, when used in that time frame, was 2.0. So we are even more elevated than in that time frame during the .com bubble.
The real question is, when will the music stop? No one knows, and even Dimon says that the bull market could last 6 more months or even 2 years. Bull markets could go on a lot longer than you think.
If we were to experience, let's just call it a 30% correction, here are some thoughts to consider about how that may impact you. If you are at or near retirement, this could have a serious impact on your retirement savings. If you're at RMD age, meaning the age at which you must begin taking withdrawals from your retirement accounts, which is currently 73, correct, Sherry?
Yes.
And then it'll be 75 starting in 2033. Then a 30% drop would cause a drastic difference in the amount that you take from one year to the next. RMDs are calculated based on the age and the year-end account value. If your RMD in 1 year is $30,000, for example, and we experience a 30% drop in the market, then it might be something closer to $20,000 the following year. Not only that, but a 30% drop in your portfolio would require a 43% increase to get back to where your account was before the drop. So add to that the potential impact of also taking your RMD in a down market, and the result could be very hard to recover from.
Very, very good.
The J.P. Morgan CEO said that he has studied other periods of market euphoria like the .com crash and found the only way to get a sense of when a bubble is coming to an end is through high valuations. He acknowledged that by many measures, valuations are high, which creates an element of risk. Part of what has led to this situation is the cheap money flowing into the market in recent years thanks to the ballooning national debt used to fuel the stimulus as well as economic easing during the COVID pandemic. Dimon added some of the investment in AI will probably be a wasted money, and some investors in technology may end up off worse.
There will be winners and losers. The current AI-fueled optimism has led the S&P 500 to 33 record highs in 2025. In terms of stock concentration, the 10 largest companies in the S&P 500 now make up a record 40% of the index's market capitalization. Volatility works for you when you're dollar cost averaging into the market, but not so great when you're taking money out to live on. This is why we manage money the way that we do.
That's correct. We are very cautious about what we invest in most of our portfolios because of the age of our clients and their risk profile. We work really hard to prevent large losses. No one can prevent all losses, but we don't ride the market all the way down to the bottom in bad times either.
So when a person comes in to see us, someone that is considering our services, the first thing we do is simply have a conversation with them. We get to know who they are, the things they have done in the past, and their goals for the future. We look at their income, expenses, assets, and debt, and talk through their future plans. Some people are years from retirement, and some people we meet with are just around the corner from it. Some people want a firm to manage their money for them, and some want us to look at how they are investing their money and just want feedback. The goals range from making a plan to pay off debt to investing their money in retirement. To help them understand what we do, I show them our portfolios and how they are managed by us.
Yep. And with regards to our portfolio, we monitor the positions every day and have alerts set up on our phones and computers so that if a particular holding were to pull back in price and start to lose either their profits we have gained or value from when we purchased it, we can take the appropriate action on that holding. So if you've had exposure to stocks, you probably have heard of trailing stops. The cool thing about trailing stops is that as stocks rise in value, it trails the price up. So if that stock starts to fall after reaching new heights, you would be alerted when it falls back to a specified percentage. An example would be if you bought a stock for say $100, and over a period of time the price increased to $150 per share. And if you have a 15% trailing stop on this stock, then the stock starts to pull back. If the price fell 15% from that $150 mark, then you would get notified and then you can take action. That's what a trailing stop does for you.
And each stock will probably have a different trailing stop. Some stocks are more volatile than others, meaning that they move a lot on a day-to-day basis, while others are steadier or less volatile. So a 10% trailing stop on a volatile stock might be too low, but it might be high for a stable dividend stock, and letting it fall more than necessary before selling.
Yep.
Yeah, there's a lot to consider when setting up your trailing stops. But one thing we would like to stress is that if you are managing your own book of stocks, do not fall in love with any one holding. Be prepared to sell it. It seems rational, but we have seen people hang on to stocks all the way to zero just because they thought it would turn around, or if it was a gift from a relative, etc. So be a disciplined investor.
Great comment.
We have time or no? We good?
We're real close. I think
Okay.
we can do the next
Start one?
Yep.
All right. Congress thinks that hiding fund fees is good for you. Pretty funny,
Of
isn't
course they do.
A bill passed by the House and pending in the Senate would authorize portfolios often used in retirement accounts to skip reporting the expenses of certain funds they may invest in. Poof! Just like that, annual expenses can range from 3 to 18% or more, and these would disappear from the standard disclosure of fees in the prospectus. You'll still bear the cost, though, in your investment returns. The pending legislation simply says that the standardized table of fees in prospectuses would change. The fee table of a mutual fund or similar portfolio, for example, a target date fund or for 401k plans that invests in a basket of other funds, would no longer have to include the expenses of business development companies or BDCs that it invests in. A target date or similar fund would, however, still need to account for the expenses of any other type of fund that it holds.
So, Jonathan, in your past career, how many people do you know that actually read a prospectus?
Zero.
Nobody
Zero.
looks at it. And so they have no idea.
These
what
things,
the
they
fees are.
normally come to you as a small book, and they're usually like 10 pica or the size of the print.
You need a magnifying glass to
Yep.
read it.
And most of it's legal jargon. And there's usually one small paragraph in there about the fees.
Right. Just nuts.
It's just not, it just doesn't make sense to even look at it.
right.
Most people throw them directly in the trash.
In the trash.
Yes.
We get so many phone calls. What do you want me to do with this thing?
Right.
No, you need to read it.
Right.
All right. So your target date fund might hold an index fund that charges 0.03% in annual fees, and its fee table would reflect those expenses. At the same time, if it held a BDC, business development company, with annual expenses of, say, 10%, it would treat that cost as zero. Why should BDCs get such a sweetheart disclosure deal? BDCs are funds that make loans to and may help manage small and mid-sized private businesses. Those activities generate high income, but the BDCs also generate high expenses, hundreds of times higher than, say, an exchange-traded fund that invests in bonds at a total annual cost of 0.03%. Being regulated as funds gives BDCs special tax privileges, which they don't want to lose. What they do want to lose is the obligation to have their fees reflected in the fee tables of funds that choose to invest in BDCs, a level of disclosure they claim is an unfair impediment to growth.
Assets at BDCs have grown to $451 billion from $127 billion in 2020, according to the law firm Mayer Brown, a 28% annualized growth rate. VanEck BDC Income is an ETF that holds a basket of 30 leading BDCs. The ETF includes their costs as part of its total annual expenses, which it displays in large type on its website, 12.86%. That hasn't stopped the ETF from growing to $1.5 billion in assets, though.
Almost 13% expenses. Can you
Right.
believe that?
Yeah.
Right.
Man.
It blew my mind when I read this.
That's insane. I agree with Jan VanEck. He's the CEO of VanEck Funds. He said that we know many investors don't read the prospectuses, like Randy was saying a minute ago. So we need to put a lot of thought behind the data points like expense ratios that investors should care about. Important statistics like expenses should rightfully be calculated in the same way across different types of funds and investments.
The idea of exempting funds that hold BDCs from disclosing their costs isn't merely goofy. It just seems very dangerous for investors.
Yes, it does.
It is.
If retirement funds get to omit the cost of BDCs from their own reporting expenses, surely private equity, venture capital, hedge funds, and other alternative vehicles will demand the same treatment.
And you know they will.
The next thing you know, these high fee investments will start showing up in retirement funds at a reported cost of zero. As magicians know, it's easier to pull off a disappearing act when people don't pay attention to the right things.
Yep. But here's an interesting fact. The Securities and Exchange Commission found that when investors were given a special document fully disclosing fees, 28% of them could not recall ever seeing it. And despite the overwhelming evidence to the contrary, many individual investors still want to believe higher fees are associated with higher returns.
That's crazy to me.
That is crazy and very interesting. Professionals may be just as prone to fee blindness. In survey after survey, fewer than one-third of financial advisors cite high fees and expenses as their chief obstacle to investing in alternative funds. Instead, they are worried about the complexity and high levels of administrative and paperwork. The first question on most investors' minds is usually, how much can I make on this? Instead, their first question should always be, how much will this cost me? One of the points we cover with anyone looking to become a client is the fees structure that we have for our managed accounts. It is fully disclosed, single fee based on the assets under management. Basically, the more money someone invests, the less the fee is going to be.
If someone wants or needs an annuity, we always go over the commission and who it is paid by. Interestingly, though, the annuity company pays the commission to the agent who sells the annuity, and 100% of the funds of the client are put into the annuity and placed in the investment.
And I think clients are always surprised when they
are
hear that.
If we put $100,000 into an annuity and that annuity has a 2% fee,
Yep.
$98,000 is not what's going into the annuity.
That's right.
$100,000 is going in.
That's right.
And they're going to pay us 2% or whoever transacts the deal for them, in
As a
addition to
commission.
the $100,000.
That's
Yep.
right. All right, we're at the halftime.
You've been listening to Your Money, brought to you by Lifespan Wealth Management, proudly serving Middle Georgia for over 30 years. Our mission? Helping folks just like you plan for a secure and stress-free retirement. Need a trusted financial advisor? Call us today at 478-922-8100 and schedule your complimentary consultation at our Macon or Warner Robins office. Want to learn more? Visit us anytime at retirerelax.com. Because when you plan smart, you can retire and relax. And here's something extra. We offer free educational seminars for the community. If your group needs a guest speaker, Give us a call and let's make it happen. That's 478-922-8100. Now, let's get back to the show.
Okay, next up, more working class Americans than ever are investing in the stock market. Gene Cao spends 6 days a week working at a Chinese restaurant near Tampa, Florida, dunking crab rangoon and chicken wings into the fryer. But his mornings, nights, and lunch breaks are spent managing his six-figure stock portfolio.
I love this.
I do too.
He says that in the beginning he lost some money, but that was a learning experience. Now, the 25-year-old is hooked. Cal reads financial news first thing after waking up in the morning, monitors his phone for stock alerts while at work, and checks the Asian markets once he gets home. He loves sifting through corporate balance sheets and watching the research into a particular company pay off. His full-time job pays about $40,000 a year, but he placed a well-timed bet on the Chinese e-commerce giant Alibaba in 2022 and kept investing during a lucky streak of back-to-back blockbuster years for the equities market. Now he says he's got enough in his brokerage account to put a down payment on his first home soon. I don't have to worry about living paycheck to paycheck, he said.
Cao is part of a growing group of lower-earning investors who are flooding into financial markets at rates never seen before. For decades, Americans with low to moderate income largely sat on the sidelines as high earners multiplied their wealth in a series of bull markets dating back to 1982. In recent years, they have jumped in and are now account for a higher percentage of investors with the retail brokerage accounts than ever before. Among Americans with incomes between $30,000 to $80,000, 54% now have taxable investment accounts. Half of those investors have entered the market in the last 5 years, according to a new survey of 2,750 adults by nonprofit Commonwealth and the BlackRock Foundation.
Yeah, they are part of a new wave of individual investors empowered by commission-free trading, stock tips on social media, and investing apps that make trading easy as a few taps on your phone. And they are wielding a growing influence in the markets. Individual investors rush to take advantage of low prices fueled by stocks recovery from the April tariffs tumbled earlier this year. The increase in individual investors propelled the rise of brokerage like Robinhood Markets and Webull that makes it easy to trade and have in turn drawn even more people into the markets. Some investors drove into more complicated vehicles, long considered the domain of professionals, but like future contracts and short-term options. Among newer investors, 45% put $5,000 or more into their accounts. The Commonwealth survey shows, and nearly 40% of investors new to the market since January 2020 plan to hold their investments for at least a decade or longer, for long-term goals, including retirement.
Homeownership, one traditional method by which prior generations of Americans built their wealth, has moved further out of reach, just as trading stocks has become easier and cheaper than ever. It's exciting to see more low and moderate income households participating in the stock market, said Timothy Flack, the chief executive of Commonwealth, which builds tools to help low-income workers save. There aren't that many pathways to building wealth, but people who started investing in the last 5 to 10 years have experienced a period of unusually high returns and only relatively short periods of declines. Since the beginning of 2020, the S&P 500 has risen about 130%, including reinvested dividends. This is according to FactSet. The annualized return is more than 15%, and many companies are trading at historically high valuations relative to earnings, which we talked about at the beginning of the show. That means newer investors bought in at higher prices and are more likely to face losses if the market takes a downturn, said George Eckerd, Wealth and Markets Research Director at J.P. Morgan Chase Institute. When asset prices go up, more people are being taken along for the ride, but asset prices can also go down.
Godfrey Jones started investing in 2018 after stumbling upon an investing app that let him open an account with just $20 as an initial deposit. The 45-year-old purchased fractional shares of companies like Apple and McDonald's and loved watching the dividends grow from 5 cents to 10 cents to $100 or more as he added to the account. Jones, who is visually impaired, wait a minute, he's visually impaired, but he's looking at this on his phone? Am I missing something here?
Maybe he can.
You can do that on your phone if you're visually impaired.
Okay. I just wonder how that works.
Doesn't mean you're totally blind.
Okay. Jones, who is visually impaired, sets aside more than $400 a month from his disability check to invest in a basket of stock funds, individual shares, real estate investment trusts, and cryptocurrencies. Some of his largest holdings include tech and dividend-focused funds. There have been hiccups along the way. Jones panicked in the early weeks of the COVID-19 pandemic, he said, and yanked about a third of his portfolio out of the market. Now, he said, he knows to sit tight through market downturns, and the value of his portfolio has grown to 5 figures. I would love to meet this guy. He would be fun.
We should look him up.
We should. Great
Economists,
story.
Economists and other experts have long repeated the wisdom that the stock market isn't the economy, meaning that the temporary pullbacks on Wall Street don't always ripple as far as the average American's pocketbook. The market's waviness, staying confined to the financial sphere, can be a good thing, but as most households tie their financial fate to the stock market, the risk of far-reaching downturns is greater, and many retail investors are jumping in and out of individual stocks, ignoring long-standing advice to put money into diversified funds for the long term.
Americans with below median incomes now contribute 11% of the dollars flowing into retail investment accounts, up from an average of about 6% from 2010 to 2015. The bank's in-house think tank looked at transfers Chase customers made from their checking accounts into retail investment accounts. I want to say something. This is a good, exciting, like this. These a couple of examples of guys that got really
Yes.
lucky.
Yeah.
But when you're trading options,
There's a lot more that got unlucky.
Oh, the risk is huge.
you can lose everything.
Yep.
And just last week, we won't go into too much detail, but just last week we talked about this. There was an absolute flush of a lot of investors in cryptocurrencies.
That's right.
And people who are buying leveraged vehicles, meaning you can get 3 to 10 to even 20 times the return of the underlying asset. Okay, so you think about something like Bitcoin that's already highly volatile, and you buy some sort of vehicle that gets 3 to
A multiplier.
20
A
times
multiplier.
the return up or down of Bitcoin.
Yep.
And you had a lot of people last Friday sitting high and mighty on these returns that crypto in general is giving you this year. And then so many were I think I read that 1.6 million investors were completely wiped out. Last Friday at 5 p.m. It was after markets had closed.
Wow.
And Trump made some sort of announcement that spooked people, and enough liquidation happened. So be very careful. These articles are cool, and people who have lucked out on things like options trading, they should count their blessings.
And that's a good point, Jonathan. A friend of mine called me the other day, and this is a guy that really doesn't have any money that he should be investing
this
in.
is a great example.
In anything that's risky like cryptos. And he goes, Randy, what is your opinion of me getting into crypto? I'm like, dude, you need to stay far away from it as you can. And
You can't afford to lose a dime.
Yeah, he can't afford to lose a dime. I said, why do you ask that? He goes, well, a friend of mine is telling me I need to invest heavily in this. He goes, I can double my money. And it's exactly what he was talking about.
Yep.
People who do not know his financial situation were trying to get him to invest as they were.
Right.
It's dangerous.
Yes, especially taking all of the money you have.
Yes.
Or a large portion of the money you have and putting it into something so speculative.
Yes. You've heard us talk on the show before about our son being in the military and him investing
gosh.
in the TSP even. And people around the water cooler are going, hey, the stock market's going to crash.
You need to be in the G
You need to
fund.
be in the G fund. These people did not have a clue about how to be investing, about his financial picture, his risk tolerance.
His age.
He was in his
age.
20s, right?
Yeah.
Yes. 22 years old.
Getting probably a 2.2%
Yes.
mutual
Maybe.
fund. Yeah.
Yes.
Maybe. So you got to be very careful who you're getting your
flipped
financial
out on the
advice
whole
from.
thing.
I'm sure.
Oh, yeah.
You did.
I mean, yeah, if she was one of those people that would have thrown a shoe, Preston would have had a shoe mark upside his head.
No doubt.
Yep.
But he fixed it as soon as I yelled at him.
Yes.
Anyways, on the flip side, Americans are falling behind on their car payments. Delinquency rates on subprime auto loans are at records. I hate subprime auto loans. That is one of my, I can't stand it. Anyways, since the pandemic, buyers on auto dealer lots have encountered surging sticker prices and smaller incentives for automakers to lessen the blow. To afford an automobile, more consumers, especially lower income families, have resorted to buying used cars and taking out longer loans. Now, more are falling behind on their loans, signaling that lower income consumers are struggling to afford payments as wages stagnate and unemployment ticks higher. While the economy has remained strong and Wall Street has kept buying subprime auto loans, the auto market is evidence that not all is well under the hood. I looked it up, and Georgia is not in the top 10 states for auto loan delinquency, but that could be something to do with state lending laws. Laws in states differ regarding rates, fees, and title pawn transactions, which is the worst way to buy a car ever. I looked up Georgia title pawn rates, and they are capped at 25% for the
Ouch.
first 3 months, then 12.5% monthly after that, for a combined maximum annual interest rate of 187.5%. It used to be 250%, but this is not much
That's not
better.
much better.
It's horrific. In fact, we were going to Kroger one night, and this couple and their kid were walking out the door, and the guy's like, "Hey, I got to go by the pawn shop and pay my car payment." Yeah, it's a thing.
Yeah.
Horrible.
What a random weird thing for you to hear somebody say at Kroger when you're walking by them.
Right.
You know?
Right.
Well, the percentage of new car buyers with credit scores below 650 was nearly 14% in September, roughly 1 in 7, according to J.D. Powers. That's the highest for the comparable period since 2016. And the portion of subprime auto loans that are 60 days or more overdue on their payments hit a record of more than 6% this year, according to Fitch Ratings, while delinquency rates for other borrowers remain relatively steady. An estimated 1.73 million vehicles were repossessed last year, the highest total since 2009. Delinquencies have leveled off, but remain higher than in the pre-pandemic period. The stress placed on some of the subprime borrowers was highlighted last month with the bankruptcy filing of lender Tricolor Holdings, home to more than 100,000 outstanding loans. The company, which catered to customers with little or no credit history or no Social Security number.
Which is insane.
Yeah, and they face allegations of fraud in its dealings with the banks.
Shocker.
Yeah, and there's more about them in the news today, too, so there's more to come.
I don't get how this is even allowed to exist.
Yeah,
Agreed. Subprime loans generally make up a relatively small portion of the auto loan portfolios at banks, captive finance organizations, and credit unions. But the finance arms of car companies loosened up credit over the summer, according to data from Cox Automotive, showing a willingness to take on additional risk. Elevated new car prices have been weighing on the industry for years, with average monthly payments rising to more than $750. I don't think it's in this article, but I did see this week that officially the average price of a new car has passed $50,000.
Oh my gosh.
The average price of a new car sold in America.
Average?
Mm-hmm. So that means because things like expensive trucks and SUVs are so popular,
Right.
they bring that average way up. But nonetheless, the average is over $50,000. So
Horrible.
anyway, with average monthly payments rising to more than $750, nearly 20% of loans and leases now exceed $1,000 in monthly payments. That's insane. Auto executives routinely cite a need to make more affordable cars, in part because some consumers have ended up shopping for used vehicles instead. Yet automakers often favor pricey trucks and luxury SUVs because they produce fatter profits. Ford last month said it would target low credit buyers with lower interest rates to unload unsold F-150 pickups, which is its top-selling model. A Ford spokesman said that only 3 to 4% of the company's portfolio of loans are backed by what it defines as higher-risk customers.
Interesting. The customer is constrained and under pressure, said Michael Levin, President and Chief Operating Officer of Consumer Portfolio Services, at a conference last month. Consumer Portfolio Services, a subprime auto financing company, pulled back on lending this year, he said. The amount of Consumer Portfolio Services outstanding loans that ended up in repossession more than doubled since 2022 to nearly $98 million in the second quarter of this year. So please talk with your employees and family members about the dangers of these loans. Many people do not understand credit and need to be educated on how to improve their credit rating so they don't have to resort to these types of loans. It's a disaster. All right, next up, I'm going to go on to Medicare. I'm about to go on Medicare. This is a question we received. But I had big capital gains last year. How long will I be stuck paying IRMAA surcharges? I had a client call this week with this question. She'll turn 65 and go on Medicare in 2026. She had big capital gains in 2024. She knows I'm going to end up paying more for my monthly premiums because my income will be high for that year. Question is, how long will it last? Since my birthday is in May, will I only have to pay the higher IRMAA premiums for 8 months until the end of that calendar year? The short answer to the question is that your Medicare payment would be set from the time you enroll when you turn 65 until the end of the calendar year. So you may indeed only see 8 months of higher bills if your income went down in the following year. But you might actually be able to get out of the 8 months of IRMA altogether, depending on your circumstances. The most important thing that you're aware of that Medicare looks back 2 years to determine how much you pay for your monthly Medicare premium. Part A is generally included at no charge if you have the proper work history, but the current Part B charge is $185 a month.
You pay an income-related monthly adjustment amount, that's IRMA, income-related monthly adjustment amount, if you have income over a certain limit, which in 2025 starts at $106,000 for a single person, or I guess it's probably double that for married, but it doesn't say here. You're signing up in 2026, which means Medicare will look at your 2024 tax return and see if you're over the income limit, which has not been announced yet. If you are, you'll be charged extra based on a 5-tier pricing schedule that starts with an extra $74 a month and tops out at an extra $444 a month. If you start in the program in May, you would pay this additional amount until the end of the calendar year, like Sherry was just saying, for only 8 months. At some point in the fall, most likely, you'd receive a letter stating that your payment obligations, what they'll be for 2027, based on your 2025 taxes, and so on into the future. You might not have been able to avoid these capital gains in 2024, or maybe you didn't know about the rule until after you made your transactions. In any case, it's too late now to do anything about your tax record from 2024. But other listeners out there who can learn from your cautionary tale should be aware of the 2-year look back and try to avoid going over the IRMA cliff if possible.
Yes, but there are exceptions. You can claim to get out of paying IRMA, especially at the very beginning of your Medicare path. You can file an SSA 44 form, which allows you to specify a life-changing event such as a marriage, divorce, death of a spouse, work stoppage or reduction, loss of income producing property, loss of pension income, or employer settlement payment. So if any of these things happen to you after you filed your 2023 taxes, you can get a reassessment and possibly reduce or eliminate your IRMA surcharges. Say, for instance, that you took a big capital gain in 2023 from selling a business, and then you had a lower income the next year because you retired, and that continued in 2025. You could claim an exception for that work stoppage and explain that your income is much lower, and you will have to provide documentation such as your tax return for 2024.
If none of those exemptions apply to you, you could take the hit for 8 months and wait to be reset for the following year, assuming your 2024 tax return income is under that limit. If you didn't get a message until after then, try again in 2025. There are things you can do to lower your modified adjusted growth income, which is what Medicare looks at, such as qualified charitable distributions in your IRA, withdrawals, or if you're which could be what is causing your income to cross over into the IRMAA territory.
Or you can use investment losses to offset capital gains if that's the issue. A tax professional can help you with more creative methods of structuring your assets so your income is lower. I hate to be the bearer of bad news, but if none of that works and your income is still high, then IRMA is just going to be a fact of your life going forward, which is where I'm going to be next year.
Absolutely.
Something to look forward to.
Right.
Giving career advice to kids has never been this hard. A woman sent her daughter off to college 3 years ago with broad advice: get good grades and have fun. But as she learned more about AI's growing impact on the job market, her advice changed. Now her advice is to get hyper-focused on networking, get a double major, and land a job. She works in artificial intelligence in her own job at a logistics company. The AI boom's effect on the job market for young adults is creating new anxiety for parents. This article hit home for me because I have a kid who's going to college.
Yeah.
And I don't know. I don't have a clue what I'm going to. He wants to be a doctor, so I think he's probably going to be okay. But in terms of having job stability, I hope, unless robots are doing 100% of our surgeries, right? Which who knows? But anyway, this did hit home for me. Many don't know how to advise teens on what to study in college or whether they should even go. Computer science isn't as safe a bet as it used to be. So a lot of students are majoring in business.
Which I don't think that's a great idea either.
Yep. The most important thing we can advise kids to do is learn how to learn and how to think, because the only thing that we can do better than a computer is to be human. There's a growing demand for philosophy and art history majors in banking and elsewhere as companies seek workers who can apply critical thinking across disciplines. With her mother's advice in mind, the daughter Kendra is trying to do it all in the name of maximizing career options. The 20-year-old was planning to major in communications. Now she has added a second major in sociology while holding down a part-time job helping students with food, housing, and finance, plus other gigs around the campus. Using her leftover time, she attends networking events with professionals and organizations.
That's a great one.
Yeah, she's a busy girl.
Yes, she is.
Kendra says she was initially reluctant to follow her mom's advice, but she now realizes it's good to have options. Adding a major in sociology, she said, could prepare her for becoming a human rights lawyer if she decides to go to law school. Human rights will be really important as AI rises, she says. Paulette says she feels badly for pushing her daughter so hard, but worries Kendra will otherwise be left behind. She told her daughter that she had better fill up her bucket with a ton of experience this summer with whatever she can, paid or unpaid, and you have to network, which she is doing.
More than ever, having work experience during college is critical to success beyond it, because it has to set up guarantees from other candidates, can set you apart. Okay, I messed up about that. Set you apart from graduates competing for fewer jobs. Daryl Coleman used to encourage his son Jordan to learn coding since he liked playing video games, but Jordan, now at age 19, wanted to work with his hands. In June, he completed a heating, ventilation, and air conditioning certification from a vocational school. He now has a job with benefits and no college debt.
Coleman sees that as an AI-proof career path, especially since AI data centers need cooling. A forklift operator in Cincinnati, Coleman is trying to get his twin 11-year-old daughters interested in AI. Even though it will be a while before they need to decide what to do after high school, he wants them to get comfortable using the fast-evolving technology. This is a good idea at 11.
Yes.
He used an AI app to create a model of the solar system since one daughter is interested in astronomy. He also uses Gemini Storybook to help the girls create characters and stories. The first step for me is to show them that AI is something fun, he says, but I want them to use technology to learn to be more productive. It doesn't help that students are hearing mixed messages about AI. Teachers often instruct students not to use AI for homework or to write essays, and we've talked about this a lot on the show. Meanwhile, their parents are saying they need to know how to use it to find a place in the workforce of the future. Thought that was an interesting what's the word? Not dichotomy, but
Right. Yes.
Where on one hand it's like, don't use that because you're cheating, and then it's like, well, actually you need to learn to use that because if you want to survive in this upcoming world, you need to learn how to use it.
Sarah Hernholm, who runs an entrepreneurship program for teens, says that when he saw AI at school as bad, he prepared kids to fail. She recently surveyed clients about what they want from their program and found that courses in AI readiness were among parents' top requests. Matthew Miner, a financial advisor in Beaverton, Orr, says high schools aren't preparing students for what's to come. He's encouraging his 17-year-old daughter and 16-year-old stepson to get real estate and mortgage licenses. He and his wife own some rental properties, and he wants to get them thinking about careers in real estate. I tell him, look, AI is coming, and it's good to have skills that AI can't easily replace, he says.
That's not bad advice.
Very smart. The next frontier. Corn is a platform for biomaterials, plastics, and chemicals. The next generation of corn is already in a coffee shop near you. The cup you're holding might be lined with a bioplastic that comes from fermented corn sugar rather than petroleum. Corn has fueled economies since ancient times, supercharging industries from food to fuel to packaging and bioplastics. But its next act could take place on more of a cultural stage as companies turn the crop's waste into clothing. If you didn't get the clothes, it sounded like clothes and clothing. Corn is undergoing a transformation into a renewable industrial feedstock by the hand of new technologies. This year, a United States startup released Corn Next 17, a biodegradable polymer made entirely from corn. These developments follow increased use of this bioplastic polylactic acid made from fermented cornstarch, which is now employed in compostable cups, packaging, and 3D printed materials. Brands including McDonald's and Starbucks are already testing PLA line cups in response to municipal composting requirements. That corn is so plentiful enables these efforts. Pretty cool. Anyways, we can fill you up on the rest of this article next week, but it's very fascinating because corn has not looked at anything like this historically.
I know this. Corn was kind of passe for a while after
Yes.
the ethanol thing went out. People
Yes.
didn't want it, but now
Here
it's
you
back.
go.
It's back.
All right. Anyway, thanks for listening, everybody, and we look forward to being with you next week.
Thanks for listening to Your Money, produced by Lifespan Wealth Management. As financial advisors, the main thing we do is provide retirement planning and advice and manage our clients' investment accounts. If you're looking for a financial advisor, please contact our office at 478-922-8100 to set up a free consultation. You can learn more about us by visiting our website, retirerelax.com. If you have a question or topic you'd like for us to address in a future broadcast, email Randy at rfmoney.com. We look forward to connecting with you next week. Have a great weekend, everyone.
Securities and investment advisory services offered through Osaic Wealth Incorporated, member FINRA SIPC. Osaic Wealth is separately owned, and other entities and or marketing names, products, or services referenced here are independent of Osaic Wealth.